morning and welcome to ActivTrades News. I'm Leah Milner. Today I'm going to be joined by Neil Kimberley, foreign exchange analyst and newspaper columnist. Firstly, we're going to be discussing a divergence of opinion that's emerging on the Federal Reserve's Board of Governors, with two members of the rate setting committee speaking out against any near-term interest rate rises. This goes against the leadership, Janet Yellen and Stanley Fischer's view that interest rates will need to start rising before the end of this year. China has been dominating the news again this week, with President Xi Jinping's state visit to the UK. The Chinese central bank is looking to issue sovereign debt in London in a bid to popularise its currency across international markets. Also in China, the economy grew faster in the third quarter than expected, with GDP growth of 6.9%. That's the slowest rate since 2009, however it's better than the expected rate of 6.7%. We'll be discussing the challenges facing China in its bid to grow its global dominance against a backdrop of difficult economic conditions and also questions over its human rights record. Finally, we'll turn our attention back to Europe, where the ECB has kept interest rates on hold. With the Eurozone dipping back into deflationary territory in September, we'll be considering the likelihood that the central bank will extend its quantitative easing programme. So Neil, thanks for joining us again on ActivTrades News. Welcome back. Let's start with the Federal Reserve. It seems like the rate setting committee is sort of pulling in two different directions now. What's sort of at the crux of that disagreement, do you think?
I think Brainard raised the issue about the dollar. Well, let's be honest here. At the beginning of 2015, the Federal Reserve said it was more likely than not that they'd raise interest rates by the end of 2015. Mm-hmm. At the same time, everybody else was in easing mode, Bank of Japan, ECB, even China. No one should therefore be surprised if foreign exchange traders didn't rationally buy the dollar for the beginning of the year. Yeah. So we've had a appreciation in the dollar index, which is an effective tightening of US monetary policy without formally changing the benchmark rate. Brainard understands that, but it's a consequence of the communications policy of the Federal Reserve. The issue for the FOMC, as far as I can see, and we're going into the October meeting and then December, is the benchmark rate near zero, which was put in place in 2008, still relevant in 2015? Are emergency settings still the right place to be? Now, I argued before and for many months that the Federal Reserve needed to raise the rate. They haven't. You know, they get paid the big bucks for making that decision. But the bottom line is, at some point, they're going to have to cut. And they haven't raised, so it's going to be even more difficult to cut. And you cannot deny the business cycle. We've avoided recession in the States now for 5 or 6 years. It will come. The rest of the world is exporting this inflation into the United States of America. Yeah. It will turn into deflationary bust at some point. And then we'll be talking about the next bout of US QE. Now, if they'd raise rates, they'd have a chance to cut. But thus far, they haven't. They've been hiding behind everything you can think of. Last time they were hiding behind China. Well, China's just cut rates again. You could argue that makes it more likely the Federal Reserve might be more comfortable and may now raise rates. But they're in the middle of this internal debate. The bottom line is, if they're all honest with each other, they've missed the boat. Right. And now they don't know whether they should try jumping off the end of the jetty and catch it, or whether it's too late.
It's pretty scary stuff. Do you think that the board members airing their views sort of in public and showing this disagreement is actually contributing to the volatility? Or?
Well, volatility is going to be there anyway because we need volatility to make money. I mean, anybody who's using ActivTrades, we need a bit of volatility. Not too much, but we need a volatility. You don't make your pips if the market's not moving. In terms of airing the debate in the public arena, does it suggest to me that perhaps some people don't think they're listened to when they get inside the committee? Maybe. Janet Yellen, primus inter pares, Stanley Fischer. He was a very big fish in a small pool as Bank of Israel governor. I would imagine he's going to be, he's a tough debater. I've got a lot of time for him intellectually. But people will be trying to carry the day for what they want. And the way it looks as if it's going is it's going to be more difficult for Janet Yellen to push through a rate hike, if that's what she's doing. I always wonder whether the glasnost, if you will, of the FOMC members speaking publicly is to kind of allow the committee headed by Yellen to find a way out of the avenue they've got themselves into, that we're going to raise rates by the end of the year. Well, I'll give you a clue. You've only got 2 months left, darling.
So basically the two committee members who are rebelling, in a way, then bringing forward that argument helps the Federal Reserve to sort of explain why it hasn't acted.
If they are rebelling, or are they just running interference for Yellen, to use an American football analogy? Are they opening the debate to allow Yellen a chance to formulate a tactical withdrawal from that which she's been committed to for most of this year?
Do you think her position's looking increasingly untenable?
I think Miss Yellen has a problem with the market in the sense that you can't keep leading everybody up to the top of the hill and then leading them back down again. I suspect she is also conscious of the fact that if she raises rates when the ECB is easing, the Bank of Japan may ease again. I mean, when this airs, we won't know what the Bank of Japan has said at the end of the week. We have China easing, then the Americans will be the only ones tightening when everybody else is easing. Then surely the dollar's going to go up again and you're going to have more of the same problem. But the issue for me with Ms. Yellen is she the right person to carry it through now? And I keep coming back to the Stanley Fischer. Is he the guy? I just wonder whether Ms. Yellen is losing a degree of credibility with the asset markets generally.
Right, okay. And have you any thoughts on which way the December decision's likely to go?
Based on what I've seen so far, and I think they should have hiked already, because I think they need to cut, they will need to cut. I suspect they'll find a way out of not doing anything. The problem is if Ms. Yellen thinks she's being backed into a corner and essentially forces through a hike at this point, will it be too late? Will it be seen by the market as having moved too late in the day? I think that's the issue. Will we end up like the ECB did a few years ago, tightening policy just as the economy is starting to tip over again?
So what about China? There are these plans now to launch sovereign debt in London. How important is it for China to have London's support in that respect?
Well, London should be eternally grateful for Greenwich Mean Time, because we are set in the middle. Also, London was the place where the euro-dollar market was developed in the late 1960s. So, from a global perspective, if China can develop the renminbi yuan bond market in London time zone, it massively moves towards two things. One, they will be able to borrow more in the global markets. Chinese corporates will be able to issue more bonds, which is they're going to need to do, by the way. And secondly, it will help the internationalization of the yuan, because it becomes more acceptable. In the same light, when, and I do expect the IMF to agree this in November, when the yuan joins the SDR basket, a lot of central banks will be looking to buy the yuan because the IMF has said, okay, this is fine. And also remember, just as with the Bradwell nuclear station in the United Kingdom, British standards of governance, whether it's checking out a nuclear power plant or whether it's the rule of law in the bond markets, are second to none. People love English law, and consequently, it's very, very useful for China when selling their wares to the rest of the world in terms of bonds that the British market has accepted it from day one.
So it's a bit like it's a bit of a seal of approval, really, a kind of British safety standard almost.
It's a kite mark. It's a kite mark, if you will. And China and Britain at the moment are kind of best friends forever, as we saw last week with President Xi in London. No doubt there'll be hiccups along the way, but clearly, just as the Americans have announced their pivot towards the Pacific, Mr. Cameron and Mr. Osborne have pivoted somewhat towards China. And don't forget, it's only 3 years ago that the Chinese weren't talking to us after Mr. Cameron had a meeting with the Dalai Lama, so things change rather quickly.
Patch that up then nicely.
Indeed.
Okay. And what about the GDP growth in China? Because that's, I mean, it's slightly better than expected, according to analysts, but it's still not looking terribly good.
No. 6.9%, which had a deflator of 0.7%. So nominal GDP growth was 6.2% in reality. Now, we focus on real GDP, but actually it's nominal GDP that matters in this case. If I owe you £20 and I've got £20 in my wallet, if there's disinflation of 0.7%, I've still only got £20 in my wallet. It doesn't matter. So it was worse than we think. To put it into context, 10 years ago, I visited the Federal Reserve in Liberty Street, and the first thing the guy said to me is, "Do you believe official Chinese data?" And I said, "I'm a trader. I don't care. If it makes the market move, I'll go with it. And he said, okay, fine, I get that. But in reality, how is it possible that the Chinese, whose population is 3, 4, 5 times the size of the United States of America, whose geography is way disparate from America, how is it possible they can get their economic data out faster than we can?
Right.
So I detected a healthy dose of skepticism 10 years ago when I visited the guys at the Fed. I doubt that's changed. We have to understand that official Chinese data is closely related to the pursuit of power within China,
yeah.
and Prime Minister Li and President Xi have their own agenda within the Communist Party, and of course we have the 5th plenum beginning this week, which is probably why the PBOC did what it did last Friday ahead of the meeting. So I take it all with a pinch of salt. But as regards China, Mark Faber was doing an interview over the weekend, and he said, look, who would you rather believe? Data coming out from the official government, or the evidence of your own eyes of locals sending money out of China as fast as possible?
Right.
Mr. Faber thinks the local knowledge beats the official statistics every time. I don't know. As I say, I'll trade off the data if it's going to make me money. But the bottom line here is, it's less about what China says it's doing and more about what are people's perceptions. We know that there's been a massive credit bubble in China over the last few years. If they're not going to make the kind of economic growth potential that we've seen in the past, can someone tell me how that's going to get serviced, all that debt?
Yeah.
Maybe it's by issuing new bonds in London, which brings us full circle. You see, everything's connected here.
Yeah. You can't look at these things in isolation.
That's right. And I remember a few years ago when I was in China, and I was at the PBOC, and we were discussing economic policy. And they said to me, you have to understand in the West that the Americans work on a 4-year basis, every presidential term. You work on a 5-year parliamentary basis. We work on a 10-year basis minimum, because we're going nowhere. We just change the faces. So we have a longer plan. So yes, we will get from A to B. If it takes us 5 years, that's nice. If it takes us 10 years, that's okay. If it takes us 25 years, we'll still get there. You will have lost patience a long time ago, but we will continue along the path that we've chosen, because we have to get from A to B.
It's a totally different approach.
It's a totally different cultural approach. Totally different cultural approach. I remember some years ago there was a G7 in, or G8, because China was there, and there was a spat between the United States and China about, I guess, the currency. And the Chinese made the same point. You know, we will get there in the end, and they have got there. You know, people moan about a sort of 1% decline in the yuan in the August or whatever, and forget about the 20% appreciation in the previous years. But they made the same point. We are not working on the same time frame. Now, interestingly, President Xi's meeting coming to London last week, the week before the plenum, by the way, I mean, that's surely choreographed. Pictures of President Xi in the coach with Her Majesty the Queen, playing on Chinese TV just as he's about to go into the big meeting.
Yeah.
It looks good. It's magisterial, if you will. The SDR stuff is coming to fruition in November. Think of this from an American perspective. There's a presidential election coming up towards the end of 2016, which incidentally is going to bind the Fed's hands a little bit as well.
Yeah.
The United States of America has been complaining that the yuan has been weakening recently. And I get that, you know, I get that. They are 40-odd months of disinflation at the factory gate in China. They're exporting disinflation to the United States. If China joins the SDR, by definition, a lot more people are going to have to hold the yuan. And they're going to have to start buying yuan, certainly within the next 12 months. So all of a sudden, there is a natural buyer of the Chinese currency at exactly the time when the presidential election timetable would suggest that US politicians would love to see somebody buying the yuan. So it's a win-win. And as for the IMF, they've been struggling since 2010 to get the government governance decisions through. Congress has stood in the way. Another source of money is China.
Yeah.
If you bring China into the SDR, all of a sudden it ticks boxes for the IMF, it ticks boxes for the US presidential cycle, and it ticks a big box for China because all of a sudden it's showing that the yuan is an international currency,
Yeah.
and it's forcing people to buy it. And if they can launch paper in London, it's even got a British kite mark on it. What more could you want?
Brilliant. So back to Europe, the ECB's kept interest rates on hold again. What do you think the chances are that it's going to have to increase its quantitative easing programme beyond the end date of September 2016?
Based on what Mr. Draghi was saying last week, I think it's almost certain that they'll be doing something in December. You can't lead the market that way and not deliver. I think it was Einstein who said that the definition of insanity is doing the same thing again and again and expecting a different result.
Yeah.
Now, you could argue that this is an example of that. I would suggest that in reality, Mr. Draghi fully understands that he's got no choice. The governments across the EU are not, or Eurozone, are not really playing ball here, and he's the only game in town, although he must hate it. He's been backed into a corner. He needs the euro lower, and he can't say it because he desperately needs to import some inflation into the Eurozone. And he's got a simple problem. The lack of demand is structural across the world. There's far too much debt. Everybody needs to continue to have low interest rates while they hope that something's going to turn up. It's almost like Mr. McCall, really. And he will play along with that because that's his job. His mandate is to get inflation close to but below 2%.
Yeah.
Well, at the moment, he's miles away. And looking at the five-year forward inflation expectations, the market realises that. So he will do more of what he has to do. That should weigh on the euro. Big problem for the Swedish central bank, who obviously going to be risking money flowing into the crown again. Probably a problem for the SNB as well, and certainly an issue for the Federal Reserve when they meet later this week and in December, because you don't know how far Mr. Draghi is going to do. He'll do whatever it takes. That's on record, and the market at the moment is prepared to give him the benefit of the doubt because it's a trade, and that's why the euro reacted so quickly as it did last Thursday and Friday. I suspect he will do it. Do I think it will work? No. That doesn't mean anything. He's got to do it anyway, and the euro really should be heading lower because it doesn't look good, as Mr. Juncker said on the 22nd. The European Union's not looking too good at the moment. I couldn't disagree with Mr. Juncker.
Thank you. So let's now take a look at some of the economic news that's going to be coming out over the next week. Firstly, the Federal Reserve is making its interest rate decision on Wednesday, and then after that, on Thursday, the US is going to be releasing GDP figures. So Neil, what's the significance of the Federal Reserve's decision this month, do you think?
Well, based on what we've been hearing so far, there was so much built up over the previous decision. Most people would suggest that this October one is going to be no change. The issue is whether the minutes will be more dovish or into more hawkish. Now, I'm guessing that they'll stand pat because Ms. Yellen is speaking on December the 3rd, and then there's the final meeting of the year on December the 15th with a press conference. I would suspect that the FOMC will want to see how the markets are in the intervening period and then make a final decision in December. But judging from the mood music, at the moment it would appear to me that they're creating an avenue to get themselves out of this particular commitment to raising by the end of the year. And the markets have already pushed back the first hike now. So the markets have taken on board what's being said. So it would be a surprise, I think, for the market if the Federal Reserve announced a change this week.
And what about the GDP figures that are coming out on Thursday? What do you think the markets will be looking for in those?
Well, the GDP figures on Thursday become critical as regards the Federal Reserve's decision in December and what Ms. Yellen may say on December the 3rd. At the moment, US GDP growth, compared to many other parts of the world, absent China because the data is 6.2%, with the deflator 6.9% without, but compared to Europe and compared to Japan, Japan shrank in the second quarter. The US, to echo Mr. Dallas Fed, Mr. Fisher's previous words, is the best looking horse in the glue factory. Now, if the US data on Thursday comes out reasonably strong, then people in the marketplace will be saying again, assuming there's been no surprise from the Fed this week, is the near zero interest rate policy appropriate for an economy that's growing at this pace?
Yeah.
If the US GDP number comes in poorly, then that will reinforce the arguments of the doves. So in terms of the events this week, I'm actually more interested in what the GDP is than anything that the FOMC is going to say. Because if the FOMC does say something now, the entire market is going to go, what happened there? And that you can't, it's almost like a black swan. Well, it's a known unknown, but you're not expecting them to do anything. They should have prepared the market if they were going to do something surprising.
Yeah.
December seems to be the more likely day to me, and if that's the case, then the GDP number becomes more critical.
Excellent. Well, thanks ever so much for all your insights. Thanks for watching ActivTrades News, and please join us again next week for more economic news and analysis.